Hello, and welcome back to Bank Nerd Corner, your favorite podcast for bank nerd topics. My name is Alex Johnson, the creator of Fintech Takes, and I'm delighted to be joined once again by my friend Kiah Haslett, banking and fintech editor at Bank Director. Kiah, great to see you.
Hey, Alex. Happy Lunar New Year. Gong hee fa choi.
Thank you. I don't know what the second part means, but I appreciate you saying that. I actually am a huge fan of Lunar New Year, so I appreciate you mentioning that. Year of the Snake.
Yeah, so we have to acknowledge it this year, not just because I am half Chinese, but because it is my year, the Year of the Snake.
Oh, are you? Wow.
Yeah. Mm-hmm.
So, all right, let me ask you a question. In your sort of way of interpreting things, does that mean it's going to be a good year, a fortuitous year, an interesting year, a year of personal challenges and growth? Like, how do you think about that?
Anything that happens to me good this year is because it's my Year of the Snake. And then anything that happens bad to me is like, I'm going to take it really personally because it's my year and bad things aren't supposed to happen. So you know how people get around their like birthday month?
Yeah.
That's going to be me all year. And in part because Year of the Snake, it follows Year of the Dragon. And Year of the Dragon is like obviously the most auspicious animal in the zodiac.
Yeah.
And so last year, I was just bombarded by Year of the Dragon stuff. And that doesn't feel fair to the equally, in my opinion, equally good snake. And so I'm looking for the same type of energy and celebration that we had for Year of the Dragon last year for my year.
And if you don't get it, you're going to freak out because it's your party and you can cry if you want to. I like this. I like this. Okay, this makes sense.
I was so good last year. I helped all the little dragons celebrate. I waited my turn.
You were you've waited 11 years to get back to this. Well, we will all do our best, Kiah, to make that happen for you. You all heard it here first. Don't bring Kiah bad news or she'll flip out. So just keep it positive, keep it moving. Kiah, I wish that I could say we have a rundown for the show today that's going to be all sunshine and rainbows. It's a little bit not that in places. So we're going to do our best to bring our listeners the news and analysis from the banking world that they are accustomed to. In places, we'll try to keep things brisk and maybe not let our emotions get the better of us. But Kiah, are you ready to jump into some fun news stories?
Yeah, let's try it.
Okay, and fun in quotes, because I have to do the first one, which is the CFPB, the Consumer Financial Protection Bureau. Folks listening probably know what the CFPB is. We've talked about it many times on the show. And if you've been plugged into the news over the last week or two, by the time folks listen to this, it'll have been, I think, a good 2.5 to 3 weeks of really fun and exciting updates. You will know that a lot of stuff has been happening at the CFPB, and I thought it would be useful to do a quick rundown of those things, which I did already in my newsletter, but I'll recap where we are. And then, Kiah, I would love to get your sort of what does this mean sort of answer. So
sure.
Let me do the rundown. So a little more than a week ago at the time that we're recording this, Donald Trump fired Rohit Chopra as director of the CFPB, a power that he was given by a Supreme Court decision from 2024, and replaced him with an acting director, which can only be filled by someone who's been confirmed by the Senate. And so at the time, that was Scott Bessent, who is the Secretary of the Treasury. Bessent, very quickly after he was appointed acting director, instructed the CFPB staff to essentially stop a lot of the work that they were doing and sort of pause and slow down. This was followed by, I guess we'll call them emissaries of the Department of Government Efficiency, not a real government department, who showed up on a Friday at the CFPB headquarters, as they've already done at several other government agencies and departments. They got CFPB email addresses. They were added to the staff directory. And they started to get their hands on all of the various systems at the CFPB, one of the effects of which was the CFPB's website, at least the homepage of the website, returning a 404 not returnable error. So parts of the website have gone down. Elon Musk, probably not in a coincidence, tweeted RIP CFPB with a little gravestone emoji. Again, kind of hard to say exactly what that means. And then shortly after that, Russell Vought, who was just confirmed as the director of the OMB, took over for Bessent as the acting director of the CFPB. He essentially doubled down on the request that Bessent had already made to stop all work being done by the CFPB, including supervision and enforcement work, which is pretty core to what the CFPB is supposed to be doing. He announced that they were not going to be taking any additional funding from the Federal Reserve because they already have more than enough money needed to do the job. And he shuttered the Washington, D.C. headquarters, which Kiah, real brief tangent on this, as all of this was happening, I was actually in Washington, D.C. I was just wandering about on a Friday afternoon before I had to hop on a plane and come back home. And my feet just happened to take me by the CFPB headquarters building where A, there were protesters outside, and B, I took a picture of the CFPB building, not realizing that I might be one of the last people to see it in its sort of open for business capacity, because this week, as we're recording, there is no one in the office. It's been closed down. The latest update that I have heard, and again, by the time folks listen to this, so much might have changed, but at last we know, a few senior folks at the CFPB, including the supervision director and the director of enforcement, have both offered their resignation, essentially citing the sort of requests to stop all work as not really being compatible with them being able to do their jobs, which is probably fair and might actually be kind of an outcome that was desired here. So, Kiah, the CFPB, still a thing, still as mandated by Congress, it exists. But as our bank nerd friend Evan Weinberger at Bloomberg Law pointed out in an article, and he's been doing some great reporting on this, the CFPB's kind of unique structure from a funding and a personnel perspective, in some ways insulated from the whims of Congress, which I think was kind of the design, but at the same time make it sort of very easy to defang or to sort of dial back if that is the direction that the administration chooses to take it. And that seems to be what's happening. I'm not going to ask you to forecast the future. I think anything Elon Musk touches, it's sort of an unwise thing to try to guess what's going to happen next. But I would like to get your reaction to just like this sentiment that seems to exist in certain corners that the CFPB is going away, should go away, doesn't really serve a purpose. Like, what's your reaction to that? And what do you think this means in kind of broad strokes?
Yeah, the dismantling of the CFPB has led me to reflect a lot on its creation.
Yeah.
The CFPB would not be the first, probably not the last banking agency to go away if it does go away.
Aren't they, just to interrupt you real quick, I think the building they're in right now that's now been shuttered was the building that the Office of Thrift Supervision was in before they were closed down after the Great Recession.
I have heard that as well. Yeah. So the Office of Thrift Supervision, I was not a reporter at the time, so I'm not really sure how that banking agency was folded basically into the OCC, what lawmaking or rulemaking Congress was involved in. We also, the Federal Home Loan Bank, which exists, used to have an examination regulatory arm. And so this has happened. Things like this have happened in the past.
Sure.
I don't know if they have happened in this way. But it also led me to reflect, too, on the creation of the CFPB itself, which was, as you know, came out of the Dodd-Frank Act. It is an act of Congress. And the purpose of the CFPB was for rulemaking authority over consumer, federal financial protection, supervisory enforcement authority over what was deemed at the time to be a large depository institution, which was $10 billion in assets. And then non-depository financial institutions, if they operate in certain markets or are larger participants. And so, I think I think sometimes people don't like an agency or what an agency does without kind of contemplating that, the direction that an agency takes is kind of a reflection of the leadership, both at the agency and then, whoever is in the office of the president. And so it's just interesting to think that that the like a defang CFPB, what kind of enforcement and supervision power vacuum does that create? Who doesn't get examined now? And then, kind of who wants these outcomes, right? So I was looking at David Silverman's post on Open Banker recently, which was called Delete the CFPB, Be Careful What You Wish For. And he pointed out that the removal of the CFPB's enforcement and supervision arms would mean that basically like kind of big non-bank tech and some big bank would no longer have probably as rigorous enforcement of consumer financial protection laws. But the sub $10 billion institutions that are not examined by the CFPB would still have the consumer financial protection examinations. So that's something that he talked about. He also spoke a little bit about the importance of the CFPB's regulations providing safe harbors for certain types of regulations. So let's say like on certain mortgages or other consumer financial protection products, if a bank or a non-bank can show that their product is within the scope of and follows the rule correctly, it provides a safe harbor for certain, allegations of consumer harm. And that, in the same way that I always wonder, as a soccer referee, do teams want the referees to show up? And like when the referees show up, what does that do for the teams?
Yeah.
Because, I get a lot of complaints from teams about reffing. I get a lot of complaints about my own reffing. I get complaints about other people's reffing. And so wouldn't it be easier in the long run if there were just no more referees?
Yeah.
And I don't think the answer is ever yes.
Yeah.
We see when we have a referee shortage, we see that their games get canceled because people view referees as an important part of in guaranteeing the safety of the game. We see referees as, if you don't have referees, your players don't have covered insurance policies. We don't see that these games as being as fair as games with referees. So I kind of think like that's kind of the closest parallel I can think of when I think about kind of what does it mean if the CFPB can't do going forward, doesn't look like what it did in the past, and is that who benefits from this new imagination of the CFPB?
Yeah, the who benefits is the question I'm just obsessed with, right? Because I think the first inkling that I got that this was maybe going to be a focus of the next 4 years was when Mark Andreessen went on the Joe Rogan podcast, which is still like that podcast haunts me and has factored way too much into my coverage in fintech takes than I was hoping that it ever would. But one thing that was really interesting about it was that in kind of the rambling interview, it conflated a whole bunch of different things, but the CFPB did come up, right? And, I think there's an element of, it kind of goes to your point about why it was created and sort of the origin story of the CFPB. I think the fact that it sort of was the brainchild of Elizabeth Warren kind of continues to sort of haunt it in certain circles a little bit. So there's some sort of legacy elements there politically, but I think to me, I just obsessed with this question of who benefits because to your point, I actually think for the most part, mature market participants want a referee, right? To your point, like they know that's what makes the market work well. They know that's what creates customer trust. Like there is a big advantage to the space. And in fact, there are examples of bank executives on the record saying versions of like the CFPB is helpful for making like the mortgage market work fairly and efficiently, right? Like there are examples of banks saying, even though they have lots of problems with the CFPB, fundamentally we think some version of this needs to exist. And in particular, when you think about how the CFPB at a national level at least plays something of a role in trying to create consistency across states, that I think is the other thing that's really important with the CFPB. In the absence of that, it's not like, and you made this point already, consumer protection doesn't go away, right? Like we still have consumer protection laws on the books, and we still have state AGs and state financial services regulators that look at all the same issues that the CFPB looks at. The problem, as with many sort of state level regulatory activities, is it's just very inconsistent one state to another, right? And so New York and California and Illinois might have one sort of perspective. Texas, California, or Texas, Florida, Missouri might have a different set of perspectives. But fundamentally, I think it actually makes it harder to comply from a consumer protection standpoint when there isn't sort of a clear national standard. We're seeing this right now with earned wage access and the fight that sort of played out at the CFPB level, where the CFPB had one view versus the fight that was playing out state by state. And I don't know that that gets like less confusing or better if the CFPB is sort of defunct. And so I think that's interesting. The parties I have noticed who seem the most sort of delighted by what's happening are ones who I guess I would classify as our business model involves making consumers unhappy frequently. And the CFPB is friction for that business model because those consumers can complain, and then the CFPB takes those complaints and then they bring them back to the companies, and that puts pressure on the companies to resolve the problem. Like that accountability mechanism to consumers. And I would say the consumer complaint database and process is probably one of the most uniquely like effective things that the CFPB has done in the last 12 years. Like that's a thing. And that mechanism and that process of collecting consumer complaints, that drives a lot of their rulemaking, their research, their enforcement actions. And, just to use one example, Brian Armstrong, who's the CEO of Coinbase, weighed in on the CFPB and basically said, it shouldn't exist. It's redundant to other things that already exist. It should be deleted, essentially. And as multiple people pointed out in replies to that tweet, there are a lot of examples, including replies in that tweet, of Coinbase customers who get locked out of their account and don't have access to their crypto and have no recourse for getting Coinbase to reply to them or to open up access to their account. And multiple examples, actually, of those Coinbase customers getting to a good outcome by involving the CFPB in that process. And so I really struggle with this idea that there are any participants in the ecosystem who rationally think, setting the politics of it and the optics of it aside, who rationally think that the CFPB going away would be a net positive for their business. Like that, as someone who kind of puts consumer concerns above everything else in this industry, that concerns me.
The optics of, we want the CFPB to go away, but don't worry, we'll still do right by our customers. You can really trust us. We just don't need this oversight. Right. We were doing such a good job. I think there's some, I want to take it really seriously that like the CFPB, the direction of the CFPB, could be criticized, and then
we did it on this podcast, right? Like we spent the last year talking about
what kind of reform is possible short of defanging.
Totally.
Versus like, hey, did we love what was going on in 2006, 2007, 2008? That like that's kind of the reversion. The other thing too is, I assume if in the future consumer financial protection could go back to the bank regulators.
Yeah.
Who used to oversee it for the big banks. And I would also assume that there would have to be some increased oversight or a potential for state banking agencies that license the non-banks to pick up some of the slack on the consumer financial protection side.
Yeah.
And I guess maybe that's fine. And everyone's kind of prepared to do that and can do that without the CFPB's coordination or oversight.
Can we talk about one of those things that you just mentioned real quick? Because I just want to double click on something. So the prudential bank regulators stepping a little bit more in for larger banks, and obviously they care about a lot of this consumer protection stuff as well. It's a lot of it is a part of their mandate too. But I think one thing that really the Chopra era CFPB illustrated to me that I'd never really thought much about before is there are times, and we've seen a number of them recently, where what is arguably good for the consumer or good for creating a competitive ecosystem is directly opposite safety and soundness and stability concerns.
Yeah, there's a real tension there.
There really is. And like,
the Capital One interest example is probably a really salient one for banks.
Yeah, it's super salient, right? It's like, I mean, and Matt Levine and Bloomberg wrote a great piece on that, but it's like, the Capital One kind of keeping deposit betas low with sort of trickery, you can argue if it's like legal trickery or illegal, but like sort of tricky behavior. And I say that as a former Capital One customer who was mad after I discovered that was happening.
I mean, yeah, it's tricky. It's like really funny to explain
it. It is. Yeah, it's like for me, when I found out they were doing it, I was like, oh gosh, I got tricked. I didn't like file a lawsuit or anything, but like I was mad. And it did affect my decisions on who to work with. But like that is a great example of one where I think Capital One's regulator, their prudential regulator, would have been like, yeah, great, you're doing a great job. That's fantastic. Like that's
shareholders
wonderful.
Liked it probably.
Yeah, like it's good for shareholders. It's good for like your deposit franchise. Like good on you. This is a really good way to run your bank. And the CFPB looked at the exact same set of things and was like, no. And like, again, I don't know that I come down on one side or the other in terms of who was right there, but I do think the CFPB taking some action around that at least forced us at an industry level to have that conversation about what's fair for consumers and what's not. And in the absence of that, I don't think the prudential regulators will ask those questions when those objectives are in tension, if that makes sense.
Yeah. And I can't really say this because the CFPB didn't do it, but when we think about the Synapse bankruptcy and we think about any agency that could have gotten in there at any time before May 2024, before the bankruptcy filing, and it kind of, the CFPB arguably could have tried to. Like,
they had kind of the broadest latitude to kind of wedge their way in there.
Right. And I only say that because like I still kind of am of the opinion that like it was correct for bank regulators to not do more earlier.
Sure. Yeah.
Or would have been more difficult for them to legally argue that. And also we could say there is a lot of consumer harm and it's still not really like the bank regulators still just aren't really concerned about that element of the, this bankruptcy, the impacts of the bankruptcy, right? The safety, the very clear safety and soundness, the supervisory perimeter for me is very clear here for bank regulators. And I think, like, again, the CFPB also didn't take action. We don't know if there was an investigation going on in the background, but I just think that when we think about like non-banks that are not subject to, banking supervision. And right now, I don't know what remains to be seen with the new OCC and FDIC and Fed, direction, but there could have been like, a more curious CFPB towards some of these fintechs that were trying, that like ended up harming consumers, right? And the question is who takes over that now, or do they just get away? Do they get away with it?
No. It's exactly the right question. I mean, my hobby horse on this front is Tomo Credit, and the CFPB didn't do anything about them, which was annoying to me. But like, you're right though that like, is the counterfactual better, right? Like, if the CFPB didn't exist, would we have gotten to a better resolution on Synapse or Tomo Credit or Solo Funds or name your sort of troubling fintech? I don't think so. And I think there's actually very sort of good reason to argue that it would have been even worse. And so I think you make a really good point about just because the Chopra era CFPB didn't prioritize everything exactly the way we would have, or exactly the way that bank executives would have, right? Or like, we weren't the ones making these calls. It's always sort of different depending on who's setting the priorities, but fundamentally, the CFPB seen as a tool to protect consumers seems like a uniquely valuable tool to have. And I agree with your sort of overarching take that, referees sort of help everyone, even though they also aggravate everyone at the same time. And I think the biggest compliment you can pay to the CFPB, honestly, is they pissed off everyone, right? Like in some ways, that's the mark of like a really good.
Honestly, as a referee, if both coaches are complaining to me on the call, I'm like, I think I was correcting.
Yeah. It's like I'm crushing it out here because I'm doing my job, I'm doing things, and I'm like equally making everybody mad. So I think we should keep that in mind moving forward. There will, of course, be a lot more, undoubtedly, so we'll revisit this topic. But Kiah, I want to give you the next story because this is another example of a Kiah Haslett points out something from first principles that then becomes sort of prophetic for the future topic. So why don't you give us this one?
Well, we have harped on this a couple of times.
Yes.
Including, I believe, 18 months ago, which is so funny.
It's ancient history.
But let's talk about the hottest topic for the banking agencies, the new, the acting head of the FDIC, and who many expect to be the vice chair of supervision for the Fed. Their favorite topic, de novos.
Yeah.
Alex, what do you know about de novos before we get started?
Oh, gosh. So de novo equals new bank charter. Yes. So instead of buying a bank, instead of converting a charter from one charter to another, we are talking about the creation of new bank charters. And Kiah, you understand it vastly better than I do, but I think the couple just key things that I've learned from you on this subject are that de novo banks are subject to pretty careful creation and supervision early in their life because starting a bank is hard. You want your bank to be profitable. You want your bank to grow into a nice, stable contributor to the overall financial ecosystem. And partially because of those concerns and partially because of, I guess, other regulatory priorities.
Other things,
particularly coming out of the Great Recession, the formation of new de novo banks has basically ground to a halt. And so we're not making new baby banks to replace all the banks that are dying, which is potentially problematic.
Yeah. So
how did I do?
That's pretty good.
Okay.
That's pretty good. So de novos are really important uniquely to the United States banking system because they replace banks. And we have about, let's say, like 5% of the banking industry merges out every year. Well, we used to have hundreds of new banks coming online. And that kind of kept the rate of banks a little more stable. And so one of the biggest drivers behind the consolidation in the banking industry is the lack of de novo formation. De novos, as you mentioned, they are like, they're not the easiest to set up. Right. You need investors, you need a qualified management team. There's a really weird timeline where you have to apply for deposit insurance and get chartered. There's like several different types of like green lights or like approvals you need to receive. So the whole thing can just take like years before the de novo even opens. And then you try to get as profitable as possible, but you've just like, you went into a bunch of debt to stand up your bank. And so it's really kind of hard to make profit. There's a lot of reasons. So that's one reason why de novos kind of stopped forming. Regulators made it harder to form de novos because of rates of failure, not necessarily of like the 3-year-old de novos in the Great Financial Crisis, but like the 5 to 7-year-old de novos. And one reason why is because the profitability, the need to make so much money so early in your life as a bank led many of these de novos to grow in ways that were not like prudent and grow too rapidly. Right. And when you're a new bank, you don't have like time to get all these relationship deposits. So you get the hot money, CDs, right? So
it's funny because what you just described, even though the objective is exactly the opposite, is it sounds a lot like venture-backed startups being put on pressure to grow, right? Like it's like, oh my God, we need you to like get to this stage as quickly as you can, and it puts all this pressure on you.
One reason why I think de novos went away is because bank pricing on deals has, and this is like my personal aside, and I'd love to like look at the data and test out this hypothesis. Banks used to sell at like 2 times book all the time.
Right.
Now, 2 times book is for like kind of overpaying. You have to be a really good bank and you have to have an acquirer with a really good currency. No one's paying 2 times book anymore. So why would I start a bank if in 3 years I'm only going to sell it for like 1.25 times book? So pricing of the takeouts is its own separate issue. That's not really what we're talking about though, Alex. Okay. Oh, and then something else to know is that there have only been 82 de novos de novo bank charters since 2010. And
That's
there used to be like
insane.
100 to 200 a year. So this is a really big...
low. Yeah.
So we've been talking about traditional community banks, except for your aside about the venture capital, which is really funny because, Governor Bowman, Acting Chair Hill have both talked about wanting to form de novos.
Yep.
And this got brought up at Acquire or Be Acquired. And everyone was like, yes, we need more de novos. And when people said that, I think they were thinking, we want more traditional community banks.
Sure. Well, that would be the crowd who would think that way. Yeah.
That's the crowd who thinks that. But also at Acquire or Be Acquired, our friends at Claros released an open letter to banking agencies about how to establish more de novos. And they mentioned in this letter that, new bank formation is at an all-time low in the United States. The challenge is particularly acute for fintechs. And Alex, I was surprised, to see that the fintechs also want more de novo charters in the United States. And then I was like thinking, maybe something's changed in the last 5 or 10 years. I don't know if traditional community banks want fintechs to get de novos. So let's talk about, once again, let's talk about this fintech de novo interest and what might be changing in the next administration.
Oh, let's talk about it. So that was a great explanation, Kiah. And for folks who haven't read the open letter that Claros and some other folks authored, they definitely should, because it was a very good sort of summary of where we are, and kind of they have some recommendations for how to loosen things up. But I did note the inclusion of fintech there. I don't know, Kiah. I mean, my one theory, and again, I'd like to test this with data too and see if this makes any sense at all. But you're an investor, right? That's putting money into a thing. And the idea of the thing that you're investing in is we can build a better widget for financial services consumers. So give us money. It'll be a good investment. We'll go build the better widget for financial services consumers. And then you will get that money returned to you in some fashion at some point. In the olden days, the investor who's doing that is giving money to a group of probably ex-community bankers whose bank was acquired, and they have an expertise on how to serve a particular segment of the market or a certain geographic community. And they go to investors and say, hey, we can basically do this again. We know how to run a bank.
Rinse and repeat.
Yeah, we're rinse and repeat. We can build a better widget. So give us money and we'll go start another bank. Fast forward to 2010. Isn't the model for, hey, investors give me capital and I'll build a better widget for financial services consumers, isn't that starting a fintech company? And if it is starting a fintech company, well, the question then is, does the fintech company, at least early in its life, benefit from being a regulated bank? Because like when we say new bank formation, like what's really the difference between a community bank and a fintech? Like they could offer the same products. They could be very similar. They could both be chartered
Alex,
banks.
that's the core question of this entire podcast.
It really is.
Right? What's
it really
the difference
is
between fintechs and banks?
That's exactly right. But I guess one theory I'm advancing to you, Kiah, is maybe one of the differences is the runway and the sort of expectations built into the runway for the two different types of companies. Because if you're a community bank, you start with, we got to go get FDIC insurance. We have to get this application approved. We have to go through all of these steps. The first 3 years, we have to, grow slowly and carefully and profitably and make sure we're like a stable bank. If you're a fintech company, you are not considering any of those things. You are trying to get a bank partner. So this is the whole banking as a service space in a nutshell. You are trying to get a bank partner. You are trying to launch quickly. You're trying to grow and scale quickly. And then maybe if you get to scale, then you start thinking about your unit economics. Then maybe you think, hey, I'll get a bank charter. I probably, and this kind of speaks to the difference between like a SoFi and a Varo, I probably am better off to buy an existing charter, or at least historically that's been true, than I am to try to get a de novo charter as a scaled up financial services provider like Varo. And then I'll be able to incorporate the benefits of having that charter without ever having to operate under it to get to the scale that I'm at. So I think one theory I would advance to you, Kiah Haslett, is perhaps fintech and banking as a service created a different on-ramp for financial services innovation and investment that's just a more efficient way to grow and return capital than getting a de novo charter. Do you buy that?
It that kind of makes sense to me. It's funny because I feel like we never got to test your hypothesis. What happened in financial services is one fintech got a de novo bank charter.
Yeah.
And that hasn't gone really well.
But it's hard to generalize what that means exactly.
Right.
Yeah.
And so it's like we've got a sample size of one.
Yes.
And we do have some fintechs that manage to acquire charters.
Yeah, but even then the sample size is like 4 or something.
5.
It's really not that many. Yeah.
Right. And then we have the viability of the banking as a service model.
Which, by the way, the viability of the banking as a service model, this ties back to like, what about all those other banks that were formed however many years ago, but are at risk of dying or getting acquired if they don't have banking as a service? Right. So you could argue that like fintech and banking as a service is kind of a subsidy for banks that would have a tough time surviving on their own without it. So I don't know, like that's another part of this policy question.
Yeah. And so I do think as far as the timeline, the viability, the need to be profitable, the profitability imperative, the buying a bank charter has kind of always made a little bit more sense to me. I don't think that, and that is not to say one of these is easier or cheaper than the other. I don't think that those should be really part of the consideration.
Sure.
I will say that Jonah Crane pointed out to me that Governor Bowman has gone on the record that she doesn't like charter stripping.
Right. So buy a charter, and do something totally different with it. Right. Yeah.
And so that, I think that going forward, even if fintechs are interested in buying, acquiring, starting banks, they may not have her vote, right? If that application goes before the Fed board, she does not like that. She does not think that is an investment in the community. She does not think that's community banking.
No, and she's a community banker, so that's it makes sense.
But it is just interesting for me to hear basically my two worlds, right? Talking about de novos, and talking a little bit about, I think even if regulators allowed more de novos for more types of people, I still don't know how many more de novos we get.
It doesn't seem like a very good investment. I mean, that's kind of what I keep coming back to is like, it just seems like, and here's another piece of information I'd love to have. Who used to invest in de novo banks and who invests in either fintech companies or in VC firms that invest in fintech companies, and how much overlap is it between those two pools of capital? Because it's like, I honestly don't have the answer. I would have to guess
low. There are some VC venture PE companies that, maybe not venture, but VC PE companies that invest in banks and can do recaps and stuff like that. There used to be just serial entrepreneur bankers, and I don't know how many are still, that maybe we're doing this in the mid 2000s that are still doing it today, just kind of with age, attrition, different regulatory environment. It's also, and it's really expensive to add a lot of technology. Some banks used to just be able to start up and then they would do commercial real estate lending with a bunch of CDs and you could make a pretty good profit. And now you've got to make all of these digital investments up front if you want to be a bank in today's environment. And so I think it's just more expensive and there's just a lot of choices and it's a lot more competitive to start a bank because, every community bank competes with every bank that competes nationally, right?
Well, and that's a really great point. Maybe another challenge with the de novo charter then versus the de novo process now is then it was very clear, where are you going to compete? Well, we're going to compete where we are. Well, how are you going to stop other people from competing with you? Well, most of them aren't here, right? So there were all these little ponds that you could kind of fish in that didn't have a lot of competition. But now, I mean, a very reasonable question I would have if I was a regulator overseeing a new de novo application and evaluating it would be what is your right to win? Like you say, a new bank needs to exist. Why? Who are you going to serve?
You have to put that in like your business plan.
Yeah.
You have to turn in a business plan to your regulators, and we'll say like, hey, how in like 3 years are we not coming back in to fail you?
Well,
or to
and
close
like
you up, you know?
that is such a harder question to answer today than it was 20 years ago, right? Like maybe that's kind of one of the things we're getting at is I don't like, I mean, I think there are underserved segments that you can serve profitably. Like I'm not saying no one should try to start a new bank or a new neobank, but that is a harder question to answer when you have to go against Chase day one, no matter what segment of the market you're trying to serve.
Yeah. My question for you is, I'm a month behind on podcasts, so I listened to you and Mikula talk about this.
Yeah.
Should Chime start a de novo charter?
Oh my gosh. I am so fascinated by that question. So let's just say charter stripping is sort of not in vogue over the next 4 years. Let's say,
let's assume that that's not going to be.
Yeah, let's say like Nikki Bowman gets her way.
If Chime put its deposits into some of these banks, it would overwhelm them.
Yes, exactly.
Right, because remember, deposits are a debt. So
yeah.
Like,
Thank you.
The bank is going into debt.
yes. So we can't have all of those liabilities sitting on our balance sheet. I don't know. I mean, I guess they would have to go for a de novo charter. I think that as me and Mikula talked about, like lending is the very obvious path forward. I think one of the challenges, honestly, with the de novo fintech concept is, and I think this is why more of the successful fintech companies that have acquired a bank charter started in lending and then kind of worked their way into deposits and not the other way around. I would not want to regulate an institution that just got a new charter and has no experience lending, and lending is going to be how they're going to make money. Like that would scare the shit out of me, because lending, and I've said this many times, you end up having to get your teeth kicked in no matter how smart you are. That's like the first 5 years of running a lending business is just learning from experience in the most brutal way possible over and over and over again. And the benefit that like a lending club or a SoFi or some of those ones had was they got kicked in the teeth and then they got a charter, and they could very plausibly go to their regulators and say, look, we know how to do lending. We can show you all these vintages. We can show you how our model has performed over time. It'd be a tough sell, I think, at this moment in time, at least, for Chime to go to regulators and try to get a de novo charter and say, yeah, I know we're not super profitable right now. We have debit interchange. We have our little credit builder card, but we're not really that profitable. But don't worry, we're going to get into lending, which we've never really done at scale
solve
before.
All of our problems.
And oh, by the way, and this is a very noble thing that they do, but like, oh, by the way, we serve primarily low income consumers who tend to be riskier and harder to lend to anyway. Are you excited about the next 3 years if you're the regulator? Like, I'm not. So like in that case, from a regulatory perspective, I think I'd prefer to have Chime sitting on the outside, helping pull the industry in a better direction, helping set an example for the types of products that should be built for these consumer segments, but not actually weighing down my financial services system that I'm trying to protect the stability and health of. Does that make sense?
No, that makes sense to me. And I just don't think anyone who should own a bank that doesn't really want to own a bank. And so sometimes some of these fintechs don't actually want to own a bank. They don't want to be regulated like a bank.
And for what it's worth, I think that applies to a lot of the fintech companies that aren't banks. They're like very happily not banks. Yeah.
And so, but I do think that fintechs kind of wish that they had access to the funding and the payment rails. And so sometimes I feel like they, there's like discussion about wanting to have those things without wanting to be a bank.
Are you pushing me back towards my favorite topic, Kiah, which is national payment charter, national fintech charter? Because this is basically the argument for it, right? Is that like, hey, not everyone should.
I'm just saying that don't be a bank if you don't want to be a bank. Well, if you need to get a fintech license or a national payment license.
That's exactly the question, right? Is like, hey, is there a policy argument for not letting everyone start a bank or create a bank because banking is hard, and arguably how many of them do we really need now that banking is nationalized and it's all digital? Community bankers are going to be mad when they hear that. Like, I mean, maybe that's not the solution. Maybe the solution is more of a narrow set of charters or licenses that allow access to certain things that banks have that make them special and profitable and powerful, but restricting the ability to become a full bank only to businesses that like want to do it and are prepared to do it well, which is probably not most fintech companies.
Yeah. I mean, and that kind of gets it back to like the CFPB and the direction of the administration. I haven't heard anything about the like a national fintech charter or a national payments license. That might have been, we had some, trial balloons during the Biden administration in 2024 about those things. And
there was some movement under the last Trump administration on it too, right? So it's not like it couldn't potentially come back.
Yeah, it would just be interesting to. It would just I'm so fascinated by the talk about de novos and
it's fascinating.
And who really want like how many people want to be banks that like feel like they can't be banks today, but like feel under the Claros letter recommendations and under a more like transparent FDIC, they will be banks. And so I just it's always been really interesting to me. I also think that GM has refiled its ILC application. I believe the bank trade groups call ILCs banking loopholes. And I don't think they want that type of company to get a non-bank to get a bank charter. And we know that under the previous administration, the banking agencies kind of shared this belief. And we're an important moat into not letting these companies into the bank space and not letting them have a ILC. Under McWilliams, only two companies have gotten an ILC, and then the only company that's gotten one since then is like Thrivent Lutheran. And so if we have a quote unquote more competitive banking space that allows more applications and more entrants, I do kind of wonder for the traditional community banker space if they will like the outcomes of a more level playing field and of the regulator allowing more competitors, more direct fintech competitors that want to, that have the technology and have maybe a customer base already. And, they want to eat your lunch. And so I do think that that's just like, to me, a little interesting that I don't think we're being as precise as we could be when we talk about things like de novos or about like, like approaches to innovation, right? These are very euphemistic and they kind of like, it's like whatever that means to you is what it means, but it could mean something different to someone else.
Yeah, no, I totally agree. I mean, the last thing I'll just say quickly on this subject, and then we'll jump to our last story is I am of the opinion generally that there is this kind of missing piece in the market, which community banks kind of used to serve. And I think we need sort of a modern equivalent to, which is, hey, this is a thing we can build. It will become cash flow positive. It'll become a profitable business. It will never become a return the fund, exit for $1 billion type of thing, right? And so like, I do think we need some mechanism, and maybe it's de novo bank charters kind of reimagined, I'm not sure. But like, I would like to see someone build, I mean, my hobby horse is the greatest digital bank ever for teachers, right? And it's like, there aren't that many teachers in the US. There are a lot, but not like, 100 million or anything. They don't have a tremendous amount of money, so it's never going to be like an ultra profitable business. But I would like someone to build that. I think there is an opportunity to serve that segment really well. And I think there is an opportunity to make money there. It's just not like venture scale money. So I think whether it's de novo charters or it's some other thing, we need to have a mechanism for like non-VC capital to put good things in to serve the market, even if it's not your traditional community banks serving a geographically defined community the way we used to think of de novo charters. So that's I think kind of an interesting wrinkle to keep in mind from a policy perspective moving forward. Kiah, we've already gone super deep on these two topics, so I'm going to keep our next one super brief, and partially it's for our own sanity. We need to talk just for a second about debanking, I guess is the word that we're going to use. I don't even know. Quote unquote. So Kiah, let me just, based on all the reporting and all of the information that's been released, and now there's been a couple of weeks actually of congressional hearings that have all touched on this subject quite a bit. Our friend Mr. Mikula has been dutifully watching a lot of those and tweeting out the
God bless
takeaways.
him, man.
I know I
better
can't.
You than me. Better him than me.
That's what I say. So I've written about this now for several months straight, and I feel like I keep kind of trying to reiterate the same basic point. So let me try to say it very clearly, Kiah, and then I would like to get your take on this real quick, and then we will move on. My belief is that most of the things that we all sort of agree happened did happen, right? So to use like crypto as an example, I think it's very fair to say that in 2020, 2021, 2022, most regulators did not like crypto. They did not understand crypto. They perceived crypto as being very volatile and very risky. And for the most part, they suggested through various means that banks should be very cautious about dealing with or touching crypto. That had the natural consequence of causing a lot of banks to either reevaluate their relationship with crypto, decide to stay away from crypto, or just sort of adjust their risk benefit calculations as it relates to crypto. So, did a sort of de-risking around crypto and other spaces happen? Yes, I would say it probably did. I think that's kind of inarguable. Was that de-risking largely based on a sense of logic and caution that was probably appropriate, especially when you consider regulators don't exactly come from this world or understand it very well? Yes. Was it, and this is where I sort of diverge from the mainstream of the crypto space, I guess, was it a top-down conspiracy in which Gary Gensler, Marty Grunberg, Rohit Chopra, and Elizabeth Warren got together in a room and decided to destroy the crypto industry? No, I don't think so. And when people talk about it in the context of like Operation Choke Point 2.0, it's that sort of top-down conspiratorial framing that I'm objecting to. It's not some of the other fact patterns that sit underneath it. Does that make sense?
Yeah, that all tracks for me.
Okay, so that's part one. Part two is I do think, and I think in spite of Mark Andreessen and others ranting about the subject in a way that has been very annoying to me, I do think some good conversations have come out of this long term, which I'm not necessarily mad about. I was in DC last week. One of the crypto was a topic among some of the policy folks I was talking to, and there was a pretty consistent, and these are folks who are not, I would say, huge natural fans of the space for the most part. And there was a pretty strong agreement across the board that the Biden administration's approach to the space of just sort of ignore it and hope it goes away was just a bad strategy and was not like a likely approach to be successful. So I think there's an acknowledgement of that. I also think, and this has actually come up in the hearings that are happening on Capitol Hill today, as a matter of fact, as we're recording, there's a whole great conversation happening about regulatory risk and particularly reputation risk, which is, Kiah, something I'm very proud to say we've talked a lot about on this podcast over the last year or so. And sort of reevaluating should reputation risk be something that's used when evaluating the risks faced by a bank? If so, how should that be factored in? How can we sort of maybe put better guardrails around it so it's not intentionally or unintentionally misused by regulators? Even things specifically related to like getting a Fed master account. So tying back to your point about getting access to the payment system. So I think all of that, very healthy conversation. I also think there's been some very legitimate complaints about the way that the FDIC and other regulators have sort of handled the blowback from all of this.
Like, I get, my personal bias is like, I think crypto is, like it is not going to transform society,
Sure.
at least not in the next 20 years, probably. Yeah. And most banks, probably it's rightfully not part of their strategy. I can also still critique that the way that this issue was handled was not the way of like an agency that needs to show leadership.
Yeah.
And that needs to like make up its mind even. Like if the answer was no, then the answer was no.
Yeah. And stand by that. Don't try to fight these FOIA requests for information. Like I think you and I've talked about this before, right? It's like a big part of regulators' job is to maintain their own credibility. And a big part of maintaining credibility is to be just really transparent, really clear, and really just above board in everything you're doing. And we've talked about sort of the Grunberg era FDIC from a number of different lenses, unfortunately, over the last 6 months. But I do think there is kind of a cultural issue at some of the regulatory agencies around just like being transparent and not taking things personally, and like, trying to be as sort of helpfully clear to industry as possible. And then I will say the last thing just on this whole topic is, I also kind of going to your point about crypto, I still think there is ample evidence from the crypto ecosystem that even very large players in that space don't particularly seem to care that much about rule of law and don't seem to care that much about consumer harm, going back to my earlier point about Coinbase and the CFPB. And that is going to continue to make it very difficult for even people who are sympathetic to some of these arguments to really come down strongly on the side of the crypto industry. And I'll be very curious to see if the industry is able to kind of push itself in a more responsible, we want to be regulated, just give us clear rules kind of way, which I know some do, but I'm not holding my breath that the whole ecosystem is going to get behind that framing and that way of thinking. So that is I had to get it off my chest as clearly as I could. Kiah, I know you've dug a little bit more deeply into like some of the files released by the FDIC. Did I miss anything or any nuances you want to add there?
I looked at like 75% of them. There's a couple of bigger documents. The thing about these document caches is that it's like the same letter over and over and over again.
It really is. It really is.
And you don't get any description of like, or hints about like the bank size that they were dealing with. But what I was really interested to read in was, there was a couple of things. One was that there were some steps where banks had they did some beta testing. They used their employees, right? So they tried out a product, they used their employees, and then they kind of saw how that was. There were some demonstrations that banks did with employer or with the FDIC and another supervisor to show them this. I think those are good steps. The FDIC also sent several banks requests for more information, specifically a list of questions asking these banks about how they would manage their risk, including the strategic plan of how crypto activity achieves objectives of the bank's board and its contingency plan if crypto fails to achieve these objectives, the project and implementation plan, including expected volumes of activity, contemplated activity levels, cost-benefit analysis, a risk analysis. Considerations should include safety and soundness, IT, AML, and combating terrorism financing, as well as consumer compliance, vendor management, right? It's a long list of questions.
Yeah.
I think it's a good list of questions.
Sounds pretty standard.
I think I think that if you get, and I think about the banking agencies kibosh on crypto relative to what happened in banking as a service.
Yeah.
Because these are kind of happening around the same time, right?
Yeah.
2020, 2021, 2022. There's a lot of banks that want to get into crypto. And they, apparently did inform their regulators because we have this whole correspondence, right? That comes out of it. And the regulator the regulator basically says, for the most part, are you really sure you want to take this risk? And other times they said, please pause.
Yep.
I think the pause, that was the FDIC doesn't have a leg to stand on for that because the pause never ended. The pause became a freeze.
Right.
That's indefensible. That's not how we should make policy. That's and
it's like getting thrown in jail and just left there while your court date's being set.
You're thrown in jail. You never have a trial, right?
And
that's actually not allowed to be part of our constitution, right?
Right.
So, but we don't have that for banking as a service.
Isn't that strange? That is such a good point.
And what happened with banking as a service? We have a lot of banks that adopt this technology really quick. I think there's this theory that there was a specific company that was making it really easy for banks to custody or offer crypto to their customers. So it was making it really easy for banks to adopt this, whether or not it was part of their strategic. Yeah, I think that's the that's the working theory. Whether or not it was part of the bank's strategic objective, the banks could offer this to customers. So that's what happened. So middleware comes in and allows banks to take BaaS deposits and plug in all these banks. And I'm just not sure what was the communication happening on banking as a service conversations. And I'm not sure what kind of pause letter or if the regulator sent in this like list of longer questions to ask. And we kind of like live in a world where we get to see how that played out. And do we like how that played out? Who do we blame for how that played out? Do we think like the regulator should have been more active in 2020 and 2021 with these requests for information, with the pause request, with the please make every single investment before you onboard a single fintech, right? And we just kind of live in a world where like crypto blew up. Voyager did not, Metropolitan did not fail and Voyager failed. We had, potentially like Signature and Silvergate had some issues about maybe documentation, maybe deposit runs, maybe facilitation of a lot of criminal activity and a system that wasn't keeping up. But like, not a lot of other banks felt impacted by the crypto fallout, right?
Yeah.
And I don't know how many banks were like, gosh, that was like a core part of our strategy. And when we were told to pause, we had to like go back to commercial real estate lending. You know what I mean?
I know exactly what you mean. Yeah, I mean, I'm glad this is such a good analogy to banking as a service, because I think maybe one theory I would have about this, and then we can get to our last story, because I want to let you rant a little bit. I won't let you cook at the end of the podcast, but the thing on the banking as a service point that's a really good observation is, in some ways, it is the same sort of novel activity. Like, we're going to do this thing.
They get grouped together for sure.
Yeah. And like, to your point, there was middleware associated with both, right? Like, on the one hand, you have folks like NYDIG who are like, hey, we'll help you do this kind of as a service. You don't have to do anything. You can just start offering it. Same thing happened in banking as a service middleware. Like, hey, you don't need to develop the technology yourself. We'll handle this. So that same sort of intermediary risk existed in both places. I think the difference is, and I'm not excusing this one way or the other, but I think it kind of helps explain it a bit, is crypto was a very easy thing to sort of externalize and understand the risks of, right? Because like, you could look at prices. There was always in the news, like, this is up,
fully
this is
anonymous?
down.
No, thank you.
Yeah. Like, crypto was very like obviously scary. Whereas I think banking as a service was, for those of us, and I think you and I can pat each other on the back, along with a few of our friends who've been obsessed with banking as a service for a while before it was cool. We were like, this makes me a little nervous, or I don't know if I like this, but like, it wasn't the same mainstream, this scares the shit out of me, my aunt asked me about it kind of thing. Like, I think we have to remember that like, regulators are humans too, right? And so like, when you're seeing crypto in other parts of your life, and you see something like Voyager, you see something like Terra, or you see something like FTX, obviously, like, those things scare you in a way that makes you go like, anything that this is touching in my little realm, we need to like really be careful. Whereas banking as a service, I always kind of felt sort of flew under the radar. And if you studied it from a first principle perspective, you could see the problems, but there was no like, your aunt wasn't asking you about banking as a service. She wasn't like, hey, I heard Blue Ridge signed another fintech partner. Are you sure they're not going too fast? Like, that just probably never came up in the same way. And so it sort of took Synapse and a lot of the cease and desist orders and a lot of the consent orders to kind of start to cool down. Whereas I think FTX and some of the stuff that happened in crypto was more of an external event that then rippled back through the way regulators were thinking about it. Does that make sense as a theory?
Yeah, I mean, it also like just kind of shows like how risk like it manifests.
Yeah.
And what is a risk to banks.
Yeah.
And I don't know, I just and a really important thing about what was in the letters is there was no request to close accounts that I could see. Maybe it was like in the last like 25% of pages I hadn't read. But the FDIC crypto files do not prove debanking. They also don't not disprove it. It's just not in there. So I wouldn't, I don't know how that furthers like what some people want to say this activity constitutes.
And you didn't see any like, we would, but Elizabeth Warren told us not to kind of stuff in there.
No, actually also crazy, but all these letters came from the FDIC and not the CFPB.
Right.
So that, and like, I'm just going to assume that separately, most of these banks were under 10 billion. So like they wouldn't have had direct
Totally.
CFPB supervision.
So the CFPB wasn't like a boogeyman haunting this whole part of the thing. Okay, that's
they're just
fair.
not.
It's not relevant. They're not relevant,
Right,
Mark Andreessen.
right.
Okay, that's totally fair. All right, Kiah, to wrap up, we like to ask sort of unanswerable questions at time. You have a good one for us this week. I was thrilled to see this in the outline. So why don't we ask this question and then we'll pull on this thread just for a minute before I let you go.
Okay, Alex, I'm gonna ask you the question and you give me your answer, and then I'm gonna pick it apart.
Okay.
What is FinCEN's purpose, and are they doing it? And are they doing it well? And is this the best way they could do it?
Oh my gosh, Kiah Haslett. Well, I like when you put me on the spot. So I will say, without cheating at all, that I did know that FinCEN stands for the Financial Crimes Enforcement Network. And what I would have told you about that prior to thinking about it at all is that they are one of the primary organizations that sort of exists to stop the financial system from facilitating illicit activity. So money laundering, anti-terrorism, enforcing sanctions, that kind of stuff. My understanding of FinCEN has been that they are very data oriented in the sense that they take in a lot of data, suspicious activity reports being one input. They do a lot of analysis trying to sort of identify potential areas of sort of financial crimes where maybe we want to get law enforcement directed. They obviously interface, I think, pretty directly with various law enforcement agencies. And then correct me if I'm wrong, Ms. Haslett, but they also sort of exist within a broader like international cooperative framework across countries that helps to sort of monitor this, given that money laundering is very much of a global sport, not a sort of national sport. Is that fair?
That is fair. That's accurate.
Okay.
Nothing wrong there.
Okay. All right. Okay. And then your second part of your question, which I think is maybe where our discussion is going to go, is it working? And, the only thing I'll say on this before I let you cook is I have always been under the impression that when you talk to people who specialize in financial crimes enforcement, they will say, we are identifying and stopping a very, very infinitesimally small percentage of the activity that we actually want to identify and stop. So I would say, in general, no. But again, kind of similar to our CFPB conversation, I am in no way advocating for FinCEN to be deleted. Maybe we just need to think about refactoring it or maybe having a different approach. What have you learned from digging into this?
So I'm becoming a bit of a FinCEN truther.
Ooh.
And it's because I recently wrote an article about fraud consortiums. Fraud consortiums are not new, but a bunch were started in 2022, 2023. And so I decided to call up a bunch of them and ask how they were going. And one of the questions I asked almost every single company was, why are you the one to do this? Why are there so many fraud consortiums? Isn't the right amount of fraud consortiums one fraud consortium, not dozens?
Yeah.
And why doesn't the government do this?
Fair questions. Very fair questions.
And these are just kind of, why you, why this, why now? And I was talking with Jonathan Awad at BaseLayer, and he said, his BaseLayer is focused on beneficial ownership and entity fraud, identity and fraud. And he pointed out that FinCEN is for financial institutions, most of them have a send-only relationship with FinCEN. They just send FinCEN in, and they don't really get information from FinCEN. And that one reason why his consortium exists is to create an information network where financial institutions and casinos and the SBA, if they wanted to, and all these the cabbage types, which cabbage doesn't exist anymore, but the small business lenders that aren't banks can share information about people who have ripped them off or are using someone else's identity to get money, and it's ID theft. And he was saying that, if he had access to the FinCEN database, that would be maybe put him out of business, but maybe he would just plug into it and it would be more useful. But that, all these banks are doing all this work to identify suspicious activity and to identify fraud, which so like not every suspicious thing is a crime. And so, I think there's a lot of volume that FinCEN has to deal with that may or may not be a crime or is just how someone is transacting with a bank that day.
Well, and I've also heard that like fraud, like you should think of fraud and financial crimes as sort of cousins, but they're not always the same, right? So like someone can commit, fraud is often associated with money laundering or financial crimes, but not always.
Yeah. Well, and like fraud is kind of its own crime too. And I was just thinking about like how these consortiums exist because there isn't, because in the year of our Lord 2024 or 25, oh my God, sorry, 25.
Yeah.
There is not an information sharing network that allows financial institutions to give each other information, signals about different borrowers and identities and activities that would help banks stop fraud or stop crimes. And so all of these companies had to set up consortiums because the one obvious exchange won't do it.
So you're cooking now, Kiah. This is like we're getting into ranting mode. This is great.
Because like banks file millions of SARs. In 2023, there were a total of 4.6 million suspicious activity reports and 20 million currency transaction reports and 1.6 million reports of foreign bank and financial accounts. And all that information went into FinCEN. And then I found out, so FinCEN makes it really hard. Like, I don't want to say it's FinCEN's fault because there's just a lot of law enforcement agencies. Like, think of all the federal ones and then think of all the state ones and all the county ones, right? We just have a ton of law enforcement agencies in the United States. But in 2023, FinCEN said that the primary law enforcement consumer of a SAR was the IRS. The IRS, they were trying to, this law firm was trying to reverse engineer how many, SARs were used in the IRS criminal investigations. And they found out that only 1,500 cases in 2023 that were referred to prosecution from the IRS involved a BSA filing. So millions of reports were filed to FinCEN. And then only 1,500 cases apparently referred to prosecution use these BSA filings. And that's the number one user of this information. And still, yet somehow, separately, banks need ways to give each other signals. If a bank is willing to say, hey, this person ripped us off, we got tricked, learn from our mistake, right? And they don't have a good way to share that because the federal government, which mandates the sending of this information, has not mandated or prioritized the sharing of it. Outside of the banks, it's only for the law enforcement agencies that may just want to search the database. They don't have to search the database. That is just it's a database, right? And what are we doing here? What are we doing here? This is crazy.
It is a great point. It is an area I have become very interested in as well. It's fascinating, right? Because I think to your point, it's like we have inputs and we have outputs as it relates to financial crime, right? And so an input is from the banks, hey, here's all the suspicious shit that we're seeing. Put it all in your database. And then an output that comes out at some other point and in some other form is, hey, here are all of the entities that you as a bank are not allowed to work with. So don't work with any of these banks, right? Or don't work with any of these companies, don't work with any of these individuals. And this is OFAC, Office of Foreign Asset Controls. There's these lists that you're sort of supposed to check when you're doing AML compliance. So it's we have inputs and we have outputs, but in the middle, there's this strangely black box that no one really has access to and that's flooded with way more information than we know what to do with. And just to give you one example of that I've always found kind of funny, but are you familiar with the sort of requirements around suspicious activity reports for cannabis businesses?
Kind of.
So this,
we've read about cannabis banking over the years, but
it's interesting. So cannabis banking, cannabis legal in some states, illegal at a federal level. So it sits in this strange gray zone. So technically, any bank that engages with cannabis businesses is engaged in money laundering, at a federal level, definitionally. So the FinCEN and the federal government would like to know about money laundering. And so you have to submit a suspicious activity report because hey, we're pretty sure this business is a cannabis business because they told us they're a cannabis business and they're a customer of ours, and technically that's illegal. So here's your SAR. The problem is if you submit SARs every time you interact with a business that you're legally allowed to work with at a state level, you're going to be giving the government way more SARs than they need because these are legit businesses. And so what the government sort of developed as a way around this strange problem is they have two different versions of a SAR that you can file. One is hey, we're checking the box and giving you this thing, but literally don't worry about this company. They're not bad or do anything suspicious. And then the other one is these are actual bad guys and we're telling you about them. And so it kind of illustrates this point about we sort of create this data problem for ourselves that we don't really need to create because the requirements to do it are subject to things that are adjacent to what we're trying to solve for, the problem we're trying to solve for, but not actually the problem we're trying to solve for. The other piece of this that I'd like to learn more about, so if anyone's listening, if anyone knows about this, I'd love to discuss it more, is there have been discussions between industry and regulators around the idea that for small banks in particular, there should be some ability to share not just data, but resources as it relates to financial crime prevention, because, we don't have, 200 people working in AML, right? When Chase or Bank of America or TD or whoever gets fined $1 billion for AML violations, what they do is they throw money at the problem and they hire hundreds or thousands of people to work in a department and just spend their whole day doing this over and over again. Small banks don't have that ability, but particularly in the age of banking as a service, small banks touch all kinds of novel, interesting, potentially risky use cases. And so is there a way for smaller community banks to both share data, to your point about consortiums and FinCEN and this database, but also to be able to have a shared set of resources that they can all kind of lean on and sort of combine their resources together? Because, I think one thing that we should try to remember as it relates to financial crime enforcement is this is not a competitive advantage for anyone, and it shouldn't be a competitive advantage. We want everybody to do this well. We want to stop this we want to identify this activity and stop it in the most efficient way possible. And so I like you, am baffled by the lack of existence of more, I guess, cooperation mechanisms and coordination mechanisms. Exactly.
Yeah, I someone has told me that, SARs are increasingly security theater, or it's cover your ass.
Yeah.
And I think that there's something so sad.
Mm-hmm.
I think that it's just really sad that that's the approach, and that's the perception of this tool and this potential agency. I also I want to take it really seriously. We've seen a lot of BSA AML orders to banks, and there's this, every time there's oh my god, this bank was bad at BSA, especially the BaaS banks, right? This bank was bad at BSA AML and probably is getting all these fraudsters and scammers, and then they've got to do work because they've got to really comply with the law, and if you want to do this business, whatever, and then to think that these banks are going to hire all these BSA employees and then they're going to file SARs that go into the void, and that's not going to make them safer, and it's not going to cut their fraud. I can't, the rules are not protecting or helping banks, right? And they're also Jonathan was saying that, and I had trouble verifying this because it's so difficult to find this data from FinCEN. He said 5% of any SAR only 5% of SARs filed in a year have any investigative action or enforcement action tied to them. 95% of them is just not, they're just not used. And so it's this whole thing that banks do that has no impact on crime, no impact on financial, on their fraud, on their customers. It doesn't help. It's not helping anyone. And then to be and then to think that fraud and BSA AML and money laundering, these are all issues that are getting, I think, harder for financial institutions to deal with as everything becomes more digitized. As like the scammers get really smart, as AI is coming in and making everything, so much harder to figure out what's authentic, right? And then what is FinCEN doing?
Right.
What is FinCEN doing to help?
Yeah.
Right.
No, I think it's exactly right. I mean, I have sympathy for the folks at FinCEN in that it's an enormous job. And I also think
but they made their own rules. Come on.
Well, I mean, I think the challenge with a lot of this stuff is like, and it requires, I mean, again, not to kind of go back to like, government regulator, what should we be doing differently in the next 4 years? But like this would be an area that would be really cool to see some sort of congressional focus on, combined with like very focused like executive action, because the sense I get talking to people who have worked at FinCEN or who work there now is like they would love to do a lot more of this stuff, but like just the way these systems are set up, the rules around how they're supposed to work are tough. And this verges into an area that's really challenging to work in from a policy perspective, which is the flip side to stopping financial crime is financial surveillance. And in America, we have a strong allergic reaction to anything that even sort of vaguely feels like financial surveillance. And so I wonder, to your point, if industry-led coordination that's like lightly facilitated by FinCEN or by the federal government, but is much more like industry oriented than it is like the Fed has this big database. I wonder if the Federal Reserve or federal government has this big database. I wonder if that's the right way to approach like moving the ball forward without triggering that allergic reaction around surveillance and privacy and stuff. Because I think that's the other thing you'd hear from folks at FinCEN or folks who live in this world is like, we'd love to have more coordination. We have a lot of this data. We'd love to use it in different ways, but like people will freak out if we do X, Y, or Z. So that's the other thing I think that you need to kind of solve for. But I agree. It's a fascinating world for folks who haven't read this piece by Kiah. You should go check it out. I always love it when you get involved in like these, like, why, how, well, what about, kind of things.
It was funny because I just had to leave that question to the side fully. It just does not belong in an article that is
not going to get a
explaining
satisfying
the impact
answer.
of these fraud consortiums.
Yeah,
but it just was like, I was just like,
it was bothering you.
I had never thought about FinCEN like as much as I was writing this fraud consortium article, and then just being like,
they published a really interesting report not that long ago. FinCEN did
some good reports.
Yeah, there's some research that's interesting too.
They're also their stuff is like on a serious lag. Like the most recent stuff you can get from them is from 2023.
Right.
And yeah, I don't know. I was just kind of confused about the role that FinCEN could, and curious about the role that FinCEN could play in a consortium-like situation, and just thinking a little bit about the signals it receives and the signals it could send, and especially as we think about the implementation of the AML Act of 2020 going forward, the BOI registry, which is like once again on pause. Jonathan made me very concerned about entity fraud. So I was like, I don't know, man. I think it's a good thing that there's a BOI registry. So yeah.
No, it's a very interesting subject. Well, thank you for broadening our horizons, Kiah. As always, this was a delight to record. Hopefully I can get you to come back again next month, and we'll keep geeking out about bank and fintech topics. But until then, thank you.
Yeah, thank you.